Good afternoon, everybody, or good morning, wherever we are in this fine country of ours. My name is Graeme Allan. I'm one of the regional wealth leaders at IDC Win, along with my partner, Alex Chan. We always delight in bringing good content that's going to make a difference to the work that you do on behalf of your respective clients. Today, we've got another good one, and this is probably our last session for the year as we head into the end of 2023, and obviously a timely time to do a wrap up to look at what's happened, and maybe look at Ashley can look into his crystal ball and see what's maybe around the corner for 2024. We did have the invite today that there was three amigos joining us from Empire, but unfortunately one of those has been unable to make it. Paul Holba, CIO, has given the nature of his job and the fact he is really quite important. Unfortunately, he wasn't able to join us, so I know he sent his regards for that and apologies. And we'll hold them to maybe the rain check and get him on the line next year, early next year. And I know he'll be willing to do that. That's the thing. That's very much engaged. But we have two people to present today, and I'll say these are the workers. Paul's the front guy. Here's the workers on the call. We have Ian Kerr, a very good friend of myself, and Ashley Misquitta, one of the top portfolio managers. I'll let Ian do the formal introductions on that case and backgrounds. So we've got 50 minutes or so. I know this is going to be a good session. Ian's going to cover some business concepts, some product stuff as we have to have out there. There's some things going on at the end of the year with Empire Product you need to be aware of. Some things happening next year with product, and I'll leave that for Ian to cover. So with that, Ian, I'm going to head backstage and give the screen to your fine self.
I thank you very much, Graeme, as always, and thank you all at IDC, advisors on the line joining us this afternoon or good morning. We really appreciate it that you're making Empire your choice today. Welcome. Again, my name is Ian Kerr. I am the wholesaler for the region of Toronto Central, and I know that I am joined by my colleagues across the country, your wholesalers from whatever region you're in. We are certainly here to help you with your business, especially as we wind up the year. A couple of things that I want to share with you all before we get into the presentation proper from Ashley. I just want to make sure that you're aware of a couple of things that are going on. And I'll finish that off with just a little insight as to what have we been doing in the kitchen? What are we actually cooking at Empire that can help you with your business and gain some sales traction with your clients? So I just want to start off with and tell you that we have a choice of guarantees, and I'm not going to bore you with this at all, but you should know the matrix of what we offer at Empire Life. We offer something for the business owner, starting with a 75-75. A lot of those folks like that creditor protection element of the seg fund contract. The 75-100, we know in this business, represents about 68% of all sales. People are really liking the 100% death benefit protection that is afforded through that contract. One of the more unique, and it's becoming more unique every year, is our 100-100 contract. Quite frankly, not all manufacturers still offer a 100-100 contract. I have a fantastic, what I would call concept that I would share with you one-on-one. If you're looking for clients who are looking for what we call assured outcomes in their retirement, we offer a 100-100 concept that I think would be quite attractive for you to hear as well as your clients to hear. But in the forum and the time I have today, I can't go and do a deep dive on that. What you should know, though, is that we do have an annual automatic death benefit reset on all three of the contracts. That's right, folks. All three of the contracts. That includes our 75-75 contract. Take a look at the landscape out there and ask your wholesalers at other companies, do you offer a death benefit reset up until age 80 annually on the anniversary of the policy on the 75-75? Most of those death benefit resets across the industry will only be applicable to the 75-100 and 100-100 contracts. So certainly bear that in mind as we go forward. As well, I know that there's an aging population. Something you really need to be aware of that we offer at Empire on the investment side is the fact that in our 75-100 and 100-100 contracts, a lot of the attraction, of course, is what? The 100% death benefit guarantee on those deposits. But you really got to know this. This, I think, is a fantastic opportunity. If you look at your client base in your book today and ask yourself, who is on the cusp of turning age 80? Like 78, 79. Could this be a possible consolidation opportunity? Because if you have a client establish a 75-100 or 100-100 contract with Empire, and they do it before December 31st of the year in which they turn 80, So a client could turn 80 in January, but guess what? We're in November. We could still have that contract open for them. And why? Because if they open it before age 80 transpires, we will offer them the ability to make additional deposits up until age 90. And those deposits are all going to be death benefit guaranteed. So bear that in mind. Be proactive with your book of business and get to those clients who are 78, 79 now as opposed to later. We also offer preferred pricing. So once you're doing that consolidation method there by getting those outside assets, we offer some preferred pricing at Empire, which you need to be aware of. We have preferred pricing with 0.25% reduction starting at 500,000 to just shy of $1 million. And then when we get to $1 million plus, we're looking at a 50 basis points reduction or 0.5% reduction. But what have we done this year? New for 2023, we want to make it easier for you. Not everybody's walking around with $500,000 or $1 million, but there's a whole lot of folks out there with several accounts scattered about. And when you consolidate those accounts, you're looking at $250,000 to just shy of $500,000. One of the best attributes of the product is the fact that we do householding. And that's really, really important. Householding allows you to get to that $250,000 number and get that 10 basis points reduction in the MER a lot easier. A client can have 200,000, a husband can have 200,000, for example, in an RSP, and his spouse will have $50,000 in a TFSA. Well, neither of them individually would qualify, do they? But when we consolidate them together as a household, $250,000 is the magic number, and we apply our preferred pricing to both of those accounts. Very, very strong value proposition when you're talking about consolidating your clients' outside assets. Let's bring them on into the IDC family. Very quickly, I'm going to talk about our Class Plus 3 highlights. Very quickly, you should note this, is that we provide guaranteed income for life. Clients got a pulse, we're paying. Guaranteed for life regardless of the market value. That's what we call our Class Plus 3 product at Empire Life. So again, ask me, ask your local wholesaler about the exciting benefits and features of this product. The key thing you need to walk away this afternoon is understanding that that bonus that we offer, which is a 4% simple interest bonus annually up until up to a maximum of 20 years. Well, we're giving clients that full bonus even if they put business in today and settles by December 29th, which is the last business day of this year of 2023. We will provide them with that 4% bonus. That means in January, when you're doing a review, you're going to see a 4% bonus simple credit to their account. And that might help quell a little bit of angst and uneasiness if the markets don't bow out the way we would love them to for a year-end finish. Also, all of that stuff is great, but you know something? I think we're all capitalists here on the line, so you want to get paid and rewarded for your work. Understand that we offer the commission growth bonus on our gift sales, not on the Class Plus 3 product, but on our regular guaranteed investment fund, SEG fund sales. We will offer that bonus. Just to be very quick with that, we will pay you in January of 2024, and that's a very nice way for you to be rewarded a little bit extra for the hard work you've been doing in bringing assets over to Empire Life. So that's it for me, folks. Certainly, again, I encourage you to speak to your local wholesaler across the country, myself as well. We're here to help you grow your business and manage your business. Now, I'm very excited. Let's get to the meat and potatoes of this presentation and why most of you are on this line. You heard our value propositions. One of the best value propositions, though, is our portfolio management team. And I'm very excited to have Ashley Misquitta on the line with us here this afternoon. This gentleman knows his stuff. I am going to give you a little bit of a preamble so you know exactly who Ashley is before I turn it over to Ashley. So Ashley joined Empire Life in 2017 as a senior portfolio manager. He is a member of the investment team providing investment management for segregated funds as well as our mutual fund suite. Ashley is the lead manager of the Empire Life American Value GIF and Empire Life Global Dividend Growth Fund. He is the co-manager of the Empire Life Global Equity GIF, Empire Life Global Smaller Companies GIF, Empire Life Elite Equity GIF, Empire Life Asset Allocation, and Empire Life Global Asset Allocation GIF. You think he's busy, folks? Absolutely. Ashley has held progressive roles at various investment management firms, including as co-manager of an award-winning U.S. equity fund at a leading Canadian investment firm. His experience includes working at two of Canada's major financial institutions as an equity research associate, where he developed expertise across multiple sectors. Ashley holds a BA in economics from Western University and an MBA from the University of Notre Dame, go Irish, in the investment and corporate finance. He also holds the Charter Financial Analyst, the CFA designation. Everyone, please give a warm welcome to Ashley Misquitta. Ashley, over to you.
So thanks so much, everyone. It's a pleasure to be here with you. As many of you, who, if you've heard me before, you'll know that I really enjoy talking about this stuff. I really enjoy speaking with our clients. And so this always tends to be more fun, I think, for everyone if we add some interactivity to it. So please, if you have questions, please don't be shy, to join us at the end, jump in with them. So why don't we jump right on in here? I'm sure you've all read this in great detail now. We've shown this to you, and as we go on to the next slide, we're going to talk about just what we'll be chatting about today. We're going to talk a little bit about our investment team, the process, the philosophy. I'll provide an economic update, a market update, and then talk about some, I think, important secular tailwinds that are going on in the world. The way I've done this in the past, in the past few years, what I would do is I would go through like a bunch of different slides, and by the end of it, I would try and tie it all together, and we would first look at the trees, and then look at the forest. And I sometimes worried that we got so into the weeds, the big picture didn't come through. So I've started doing things a little differently. We're gonna look at the forest. We're gonna talk about the bigger picture, how it all fits together, and then we're gonna go through a few sort of slides in detail that will describe and show a little more clearly some of the stuff I've talked about. But moving on first to the investment team. Here's the Empire Life investment team. This is the equity team here. You'll recognize some of the faces. These are the PMs and the senior PMs. On the next slide, you'll see our analyst team. We've added a number of analysts. This will be, for those of you who've seen this presentation before, seen me present before, or other members of the team, you'll notice there's a lot of new faces here. We've added Niraj, we've added Kevin, Brendan, Jeremy, and Mohammed in the past 12 to 18 months, I think. So we've added to the analyst team. We've grown. There's a few things that I think are interesting and important, like everyone kind of shows their team. Here's what I think are the important things for you to take away. I've been fortunate in my career to work at investment firms that have a very strong investment culture. And what I mean by that is, or maybe let me just say, like, that's obviously good for me, right? Because it's a good culture. It helps develop people. That's good for me. That's good for you, because you want analysts who develop into senior PMs eventually. What it also means, and this is why I think it's valuable for our clients, is that a good investment culture is one where you share ideas, where even though if I come across, so I'm mostly focused on U.S. products and the U.S. Securities within our global products. I'm working on a company, and one of their competitors is actually maybe as good or better, or just a really good competitor to them, and though that company is in Europe or is in Canada, I'm unlikely to be investing in those companies directly. But a good investment culture is one where I'll be motivated to share that idea with David, or share it with Doug or Greg or Jen or one of the Canadian team, and ask them, like, if you looked at this, it's, I came across it, I thought you might find it interesting, and vice versa, right? So they'll share ideas back to get back together with me. And so that's one element of it. The second element, I think this is really important, is that many of you will have heard the phrase, the strongest steel is made in the hottest fires. The same idea roughly applies to investing, where the best ideas are the ones that we debate most vigorously and most robustly, where everyone brings in their perspective, everyone is able to challenge your thesis, challenge your assumptions. But a really good investment culture is one where, after like arguing robustly about this stuff, you're able to go and have a coffee together and go have a drink together after, where you're able to, the phrase I use is disagree without being disagreeable. Because what that means is, on the margin, we're more likely to correctly make a decision to invest in a certain stock. We're more likely to avoid a mistake. And, I joke to people that, if we're right 65% of the time, I'm going to be happy. You're going to be happy. Your clients are going to be happy. If we're right 75% of the time, people are going to write books about us. Like that's the assumption you have to recognize, and we have to recognize that there's 25% of the time at best that we're going to be wrong, and that's how the markets work. And overall, we'll do really well for clients if we were able to accomplish that. But the more we can nudge that correct number up and nudge the wrong number down, the more beneficial it'll be. And I do strongly believe that investment culture really contributes to that. I've been involved in hiring almost everybody on the team to this point, and so these are things that are key things we've selected for. So rather than just sort of glossing over and saying, hey, here's everyone, I wanted to highlight that for you and mention to you how important that is. And as on the next slide, you'll see our fixed income team as well. And we will also share ideas and discuss and debate things back and forth. On our morning call today, actually, there was an equity that we were discussing from the perspective of fixed income and from the perspective of the equity side of things. So we do have that, something I think is really, really beneficial and helpful for us. So as we go on the next slide, we're going to talk about our investment culture here and our investment philosophy. And many of you will have heard this before, so I won't take too long on it. I approach and I think of investing in the businesses that we want to own. They exist at the intersection of 3 points. So if you think of a Venn diagram where there are 3 circles, you picture 3 circles in front of you. There's one point where all 3 circles overlap. Those are the businesses that we want to own. The first circle represents very high quality businesses. That usually means businesses that have strong structural competitive advantages, things in the world that make them better than their peers, whether it's intellectual property, whether it's distribution, whether it's cost, whether it's they've been able to capture and retain talent in the industry, something that makes them better than their peers, so they're able to, excuse me, get higher margins, get higher returns, probably generate more free cash flow, be able to reinvest more aggressively in the business, return capital to us, or buy other companies. These are the businesses that, when times are tough, because listen, we're going to have recessions. There's a really good likelihood over time that we have not repealed the economic cycle. That's probably not going to be a surprise to anybody. But because we know that's true, we want to own businesses that when times are tough, they're able to get stronger because of the decisions they made early on, of the nature of their business. They're either able to take share away from weaker players in the industry, or they're able to buy their competitors outright and grow inorganically in that fashion. Usually these businesses have really good management teams. And what I mean by that is there's one of the principal responsibilities of management teams is allocating capital. What do they do with the cash and the profits that the business generates? And so looking at their history of how they've allocated that capital, have they done value destructive acquisitions? Have they conversely done smart acquisitions at the right time, or have they done it at the top of the market foolishly? Have they returned capital to investors in a reasonable way if their opportunities to redeploy were not as high return as returning capital to shareholders? So that's something we look for. Another thing we look for is management incentives. Are the incentives aligned with us? So will management teams make their bonuses and get double their bonuses when they do the things that we know will benefit investors? Or will they be compensated and bonused on things that really don't make a big difference to the stock? It seems obvious. It seems like, how could anybody create an incentive structure that wouldn't benefit shareholders? But you'd be amazed how often that happens. And this is one of my most rigid heuristics. I have a couple of times been so tempted because everything else looked really good. And we didn't buy the stock. So I was like, the incentive structure is wrong. And I know deep down, incentives drive people's behavior, and it's actually kept us out of trouble. It saved us a lot of money over time. And so that's reinforced that heuristic for me. So that I can talk about great businesses for a very long time. So that's the first circle. The second circle is secular tailwinds, or at minimum, non-headwinds. So we don't want to own the apocryphal buggy whip company from the early part of the last century. So horse-drawn carriages were going away, and the whips that their drivers used to use to drive the horses, those were going away as well. And you could have the lowest cost, best quality, best distribution, best sales force, no matter what. The horse-drawn carriage was going away in favor of the automobile. And so the secular headwinds, the things pushing your business backwards, were just too strong. We ideally want to own businesses with secular tailwinds. So one of the tailwinds that exists out there is, in the United States, the baby boom population, as we all know, is aging. It's no big secret. the numbers are staggering. 10,000 people every single day turn 65 in the United States. And we also know that healthcare costs rise as people get older. And so managed care companies are interesting. Pharmaceutical and biotech companies are interesting. Medical device companies are interesting. They will have a structural tailwind behind them that will help their businesses. Now, then you have to get into the characteristics of the business, but separately, you want that second circle is tailwinds, ideally, that are propelling the businesses forward. The final circle is valuation. I want to be really clear about this because I think I think there is some history and some reputation we have that differs than the current state of the world. We are not value investors. We are not Graeme and Dodd cigar butt investors. We don't start by saying, what are the cheapest stocks out there? We don't say, well, that PE is lower than that PE, therefore I want to buy that company as a starting point. We are value oriented. We absolutely care about valuation, but we're not trying to buy a dime for the price of a nickel. Everyone says, well, I'm kind of like Buffett. I would definitely associate myself with Buffett's comments. I would agree with his comments where he said, I would rather pay a fair price for a great business than a cheap price for a lousy business. And so we do pay attention to valuation. We will look at discounted cash flow models, earnings multiples. We'll do reverse discounted cash flow models, figure out what's embedded in the price. We will come up with an assessment of what we think the business is worth, and then say, well, what's the trading price today relative to what we think the business is worth? I don't think it makes sense to come to the conclusion that a business is worth $200 and the market price is $250. But because it's doing something on a chart, I say, well, I'll buy it anyway and hope it goes to 300. That is a way to do it. There are some people who do it that way. One of the most important things in investing is to figure out who you are and to be that. If you try and be kind of like in life, actually, if you try and be something you're not, if you try and pretend to be someone else, you're likely to have trouble over time. So this is who we are. We figure out what we think the businesses are worth, and then we try and buy them at a discount to those. And those are the three circles. And where they overlap, those are the businesses that we want to own. So that's a little bit on our investment philosophy and our approach. And as we move on to the next slide, I'm going to talk a little bit about our current view of the world. Thanks, Ian. And so our base case assumption is that we've got a recession coming in 2024. Earlier this year, I probably would have told you our base case assumption is it's coming in 23. A couple of things have surprised us. One, the degree to which the economy was resilient to higher interest rates. And I think one of the things in retrospect, you look back and you're like, okay, well, we've historically known that interest rates work with a lag, right? You don't raise rates and the next day you get a recession. We had quite substantial increases very rapidly. And there was, I think, in my mind and in the minds of others, an expectation that would pull forward the economic consequences of it, but that hasn't been the case. So that's one. The second thing is the consumer just has held in remarkably well. And is it because employment has held in well? That's part of it as well. There's been a lot of money left over that consumers have had from COVID. There was a lot of money dumped in their bank accounts, so savings had risen. And there's been just with respect to employment, you started to hear more companies later last year, earlier this year into mid this year, who basically said, we're just going to hold off on letting people go because it's been so hard to find people. And then simultaneous with inflation moving things along and moving prices up, that's helped them as well. So that's part of what if we look back, kind of what's pushed things out a little longer. I spent a lot of time thinking about how could I be wrong? This is my conclusion I came to based on all the evidence. One of the ways we do that is I started from zero. I said, I have no opinion. Let me go look at all the data again. Let me look at all the evidence again and try and form a conclusion. And I still come to the same place. I still come to the conclusion of the recession coming in 2024. Part of that is, and there's a bunch of reasons for it. One is, as I mentioned, the lag with which interest rate increases affect the economy. The second part is economic data is softening, right? So we're in contractionary territory on some indicators. The leading economic index, which is a combination of 10 different factors combined into one index, is in territory we historically associated with recessionary territory. The third thing is that, third among many other things, is we've seen the basically the willingness of banks to lend. So there's a measure that the Federal Reserve in the U.S. puts out every 3 months or so, talking about the willingness to lend of senior bankers, a senior banker survey. And that's in territory it's associated with recessions in the past. Now, recessions are determined retroactively by the conference board in the United States. Now, if we were in late 2007, early 2008, we would have said, well, it seemed like the data seems to suggest we're in a recession, but we're apparently not in a recession. Time passes, we look back and we go, oh yeah, they retroactively characterize that as a recession. So we may be in the early stages of that now. We'll know in retrospect. But we are seeing slowing in the data. We are starting to see more companies talk about softness. And so the flip side of how that could hold off actually happening is if we do see employment hold on. Employment is one of the key things that is kind of the last thing holding everything together. And so that's one of the things we're paying a lot of attention to. One of the other things we're expecting is persistent but slowing inflation. We're seeing some interesting. Today's kind of an interesting day when I was as you look at the markets, and that you've seen a couple of Fed speakers talk about, oh, maybe we'll be able to reduce rates if inflation continues to slow, and the U.S. dollar is weakened. But what we've seen recently is in the past couple of years is something very unusual. Usually, when the U.S. dollar is strong, commodities are weak. What we've seen is the U.S. dollar has been strong and commodities have been strong as well. And that's been a bit unusual. Now we saw some softness in the dollar today, but real strength in commodities. Gold was 2027 when I last looked at it. Oil's ticking up a little bit, and we've seen sort of some strength in different commodities out there. For a bunch of reasons, we are expecting inflation to remain persistent. Some of that is not going to surprise you. It's stuff we're all seeing. Think about all the strikes that we've been hearing about in the U.S., the auto strikes, the auto labor strikes, the port strikes, actor strike. It's gone on and on. And the reason is because inflation has been so high and people have been losing purchasing power. And so, not surprisingly, people want to get wage increases to compensate for that. And so that has helped put upward pressure on inflation. We've also seen real volatility in commodities, but I would argue, and I'm going to talk about this shortly, why we think there's likely to be structural upward pressure on commodities. And finally, again, a longer term pressure, but what reshoring and onshoring is also doing that. So if we are in a potentially higher for longer rate environment, what does that mean? I'm sorry, higher for longer inflation environment, that's likely to drive a higher for longer rates environment. And so that's one of the things we think we're likely to see. Is it going to, inflation is not going to be back up? I don't think inflation is not going to immediately go back to 9%, but is it going to go back to the 2 to 2.5% range the Fed wants? We think there's reasons that structurally over time that may not be the case, and that'll have corollaries for rates. The other issue is mounting sovereign debt. I've been asked about this, and I've been worried about this since 2010, 2011. And the answer, unfortunately, is kind of all the same. It will become an issue when suddenly something happens and everyone decides it's an issue. So the analogy I would use, you go back to Silicon Valley Bank in early March, when Silicon Valley Bank and Signature and First Republic and Silvergate failed. The month before, everybody knew that there were issues with the degree of mark-to-market problems that some of these banks held. But they were mark-to-markets, not actual credit problems. What we knew was when those mark-to-markets, but when those bonds eventually matured, they would mature at par. And the loss they had incurred, the paper loss, would eventually accrete down to zero. But that becomes a problem when your depositors are taking all their money out. And that was the thing that caused the crisis. But it wasn't a crisis until suddenly, some genius one of the genius venture capitalists who had piles of money in Silicon Valley Bank texted all his friends and said, hey, did you hear about Silicon Valley Bank? We should take all our money out. and then it caused a run on the bank, and suddenly that the mark-to-market losses mattered a lot more. And so it's the analogy there is things matter only when they suddenly start to matter for some reason, and it's very difficult to be able to identify that a priori. But I do think mounting sovereign debt is a worry. 3 weeks ago, we saw U.S. Treasury yields spike because there was a 30-year auction. I think it was a 30-year or 20-year. I think it was a 30-year auction that really was unsuccessful. And what that means is that banks who are the ones who have to take that debt, the government jams it down their throats, whether they want it or not, if they can't find other buyers for it. But the banks will then be able to say, well, this is what the rate we require for that is. We saw the 30-year rate went up considerably. Like, I don't remember numbers off the top of my head. I want to say like 10, 15 basis points, something like that, which I know it doesn't sound big, but that was actually huge in the treasury market for a rapid move. And that happened. Was it because the explanation was there was the biggest Chinese bank in the world, the biggest Chinese bank, which is I think also the biggest bank in the world, but the biggest Chinese bank for some reason had a tech issue, whether it was a hack or a problem they had, wasn't able to participate in the auction in the normal traditional fashion. So that was the explanation. Or is the explanation that the U.S. is being forced to issue so much more longer-term debt that the market's not able to absorb it at existing rates? So the question becomes, with $2 billion would be a joke nowadays, $2 trillion in deficits this year that the market has to absorb, plus all the new and rolling over of issuing, is that too much for the market to absorb at existing rates? And does the 30-year and the 10-year, those interest rates need to move up because of the sheer volume of debt that's being placed there, that the people who are buying it are going to require higher rates from the government? We'll see. That's something that is definitely something we have to pay very close attention to. Having said all that, we're closer to the end, I think, than the beginning of this. I would describe sort of like, call it 2020, late 2020 through early to mid 21, when this started, when things really became loony. I saw a chart yesterday or 2 days ago about the number of unicorns that were created by trailing 12 months or something like that, or each month, something like that. And the chart, and a unicorn, by the way, is a private company with a greater than $1 billion valuation. And the number of unicorns created in late 20, early 21 was bonkers. I mean, we're talking into like something like 60 companies or something like that. For reference, last month it was 2. And so it gives you some perspective of just how crazy things were then, with the meme stocks, with all of these businesses, the valuation, they were growing to the sky, they were unlimited. And so that's kind of where I would characterize the early parts of this. We're closer to the end, because then you have to have that washout, right? We're closer to the end. It may take a real recession. We'll see what happens. But we're getting closer to wanting to deploy capital. We're getting more intrigued. We're seeing more things where we're like, okay, that might be interesting. So as we move on to the next slide, what could make things better or worse? Easing or worsening geopolitical tensions, right? So prior to October 7th, 2 weeks before October 7th, give or take, Jake Sullivan, the national security advisor to President Biden, was on a panel talking about just how calm things were in the Middle East and how great that was and what a great job they were doing. Oops. And so that, beyond the fact that should worry all of us about the intelligence capacities, and I mean by like national security intelligence capacities of the US and other countries, that should make us a little nervous, I think, that they were so off the mark on that. But it also makes the point that, stuff happens out of nowhere. We're in mid-21, for example. Nobody is thinking that Russia is going to invade Ukraine. Late 21, you're seeing the satellite imagery and you're like, I mean, this must be like a feign or a trick or something, right? Because he can't be crazy enough to go invade Ukraine. And yet, these are the things that were not on people's bingo cards. So these are the things that are complicated. Now, to be fair, we've been talking about this for a while. We've been talking about the risk of the Middle East. We've been talking about various risks like that, but you never know when they're going to happen. And so what are some of the risks out there? Well, the risks are that Russia-Ukraine expands. Risks are that Israel-Palestine expands. The risks are that Iran gets involved. We've seen the Houthis, I think it was the Houthis in Yemen, who hijacked a couple of Israeli-flagged ships in the Red Sea, I think it was. You've seen the Houthis from Yemen firing missiles over a U.S. destroyer, which shot them down, and it wasn't clear, well, were they shooting at the U.S. destroyer, or were they shooting at Israel? Turns out they were shooting at Israel. Things can expand, and this is something to keep an eye on. Simmering in the background, right, is China-Taiwan. I don't know if any of you are Tom Clancy fans. I used to love reading Tom Clancy books. Dating myself a little bit. Back in the 90s and the early 2000s, and at one point in one of the novels, there was a bunch of different hotspots happening, and none of them were like catastrophic. None of them were like the assassination of Franz Ferdinand causing World War I. All of them were little hotspots. And the main character, Jack Ryan, is the national security advisor, and he turns to the president and says, all of these things are happening, but you know what they have in common? They're all making our life more difficult. And it turns out they were all connected, actually. And so you look at where we are today, and you look at Russia now selling a lot of oil to China, and China, who's short resources, potentially looking covetously at Russia as an interesting alliance. You see Iran having apparently sent missiles to Russia, and you sit there and you go, well, that's interesting, right? Because what's happening? All three are costing the West a lot of money. We're sending weapons there and not replenishing them at a sufficiently robust rate. We're working on it like that. No one's sitting there going, it'll be fine. We're not going to produce our weapons. They're growing the industrial base to produce, Javelin missiles and tanks and all of those kind of things. But so much has been decommissioned since the end of the Cold War, and so I guess these are things that we all worth paying attention to, because if money and weapons and political capital have been expended already, is it maybe an opportune time for China to invade Taiwan? Maybe not. But it is something worth paying attention to. And so these are sort of unexpected surprises that can happen out of nowhere. I mean, what have we seen just recently? Copper, and I'm going to get into this shortly. Copper is going to be an incredibly important part of the energy transition. But there's a strike at a big copper mine. I think it's in Chile or Panama. It's escaping me. There's so that's Los Bambos in the Cobre Panama mine. That's currently shut down because of local tensions, and disagreements over the rights agreement. And so could those things start to emerge as surprises? And so these are all things that we're paying attention to and keeping an eye on. U.S. politics, every election, people are like, this is the most important election ever. And it's never the most important election. I think this is actually a really important election. And I won't get into the details of it just in the interest of time. But the U.S. is really at a crossroads politically, interaction. It's in terms of its interaction with the world, in terms of economic policy, in terms of so many different things. And, I think it's a really important one, and it is one that has potential ramifications. Finally, wildcards, the UK pension crisis now, I think almost a year ago. Nobody expected that. Nobody saw it coming. It was kind of out of nowhere. And those kind of wildcards are things we're paying attention to as well. On the next slide, I'll kind of wrap up this part of things very shortly. We're doing an energy transition that is so good for Canada. It's so good for commodities. We need so much nickel, lithium, copper, cobalt, all of these base metals. Canada is in great shape for that. The problem is our governments, I know you'll be shocked to hear this, have not done the right thing. Go figure. I know it's a good thing you're all sitting down when I said that. Wind and solar are intermittent. They are not the answer on their own. They are potentially contributors. Nuclear is is a key part of this solution. Finally, we're seeing that in the past 12 months, we've seen a complete 180 from most government bodies, non-governmental organizations, public opinion. I mean, I've been, ranting about this for a long time. I was at a meeting with one of the biggest U.S. utilities in 2018. I said, like, you want to go with zero carbon emissions, modest size footprint, whole 9 yards. Why are we not building more nuclear? They're like, nobody's going to build a new nuclear plant in the U.S. ever. Well, turns out they were wrong. We are going to be building new nuclear plants, and that's really good news. We are still going to need a lot of those base metals, though, to redo infrastructure for the grid, to do the electric vehicles that I think people want, or that clearly people want. But until the government has sort of fixed this, it's going to result in increased populism, because it's going to raise costs, and it's going to make people angry. Inflation, I think, longer term. So I talked briefly about the short term. Longer term, I think inflation is likely to be a problem, right? Each new copper mine. So the rough numbers I've seen are, we need between now and 2050, I think 2040 or 2050, we are going to need twice as much copper as has been mined in all of human history. Twice as much copper as has been mined in all of human history, ballpark. To be clear, when I'm talking about stuff like this, the precise number is going to be wrong, but the general concept will be right. In that neighborhood, that's how much copper we need. But here's the caveat, or here's what makes it harder, I guess I should say. Every new copper mine has a lower grade of copper than the last mine, because otherwise we would have done it first. Every new copper mine is further from infrastructure. Every new copper mine is more expensive than the last one. And one of the things that's a new to the world thing that we're observing is many new copper mines have a great deal of resistance and reluctance because of a not in my backyard perspective from people who are near there. And so you have this contradiction between global ESG, where we want to produce more we want to be able to move to a lower carbon economy, but the things we need to do in order to do that, we have local anti-ESG sentiment. And that contrast is going to become very complicated. It'll become quite profitable if you're expecting and are positioned well for it. We think we are, and we will be more so as we get closer to those moments. But that's going to drive inflation, right? So we need, the long and short of it is, we need higher costs for all of those things. And demographics are going to be a problem as well, because China is a demographic catastrophe. Japan is declining demographically. There are fewer Japanese people now this year than last year. There are fewer Chinese people in China this year than last year. And so labor is going to become more scarce, therefore it will become more expensive. Labor will gain power relative to capital. And so prices are going to go up from there. We're doing more onshoring. That's going to raise prices. Geopolitical tensions are continuing to stay high. That's also going to keep prices, I think, structurally support inflation. And so I see a good question here. I'm going to jump into that. Actually, no, let me answer that question really quickly now, Ian, if you don't mind, if I just jump in with a couple here and there. AI. So it's a great question, and it's one we're continuing to investigate. So my baseline assumption is it will be analogous to what happened with, and there's reasons it might not be true, but the baseline assumption is it's analogous to what happened with the U.S. farm population. So in 1903, I think it was, something like 29% of the U.S. population worked on a farm. In 2015, about 2% did. And we're producing so much more on the farms than we ever used to. Our population is so much bigger. So not only did those percentage of people have to transition, there were so many more of them because the number of people who are not working on farms is so much higher. There were new industries created, which we could never have conceived of prior to that point. And so I think that there's a good chance AI will follow a similar model. New businesses will get created. Things will change, right? So to me, in the world we're in today, the most exposed risk jobs are ones where the user does not know how to use AI or is not learning AI to make their job more effective, right? AI is not going to put in a plumbing system in a new home, right? That is not exposed. You know, articling students in a law firm who go and research legal documents, that may be a risk. That may be a risk. But the people who are the law students who know how to use AI super effectively and do the work of 2 law students from before, I think they're probably going to be coveted. There will be less jobs, and some people will have to find different jobs. But I think there's a good likelihood, you know, there is risk, one that happens faster than the farm to industry transition. But my suspicion is we'll find our way through it. It is something we're watching, though. And so let's skip through here, and we're going to move really quick through these ones. So just keep your finger on ready to roll here. Balance sheets are starting to shrink from the governments. That's a good sign. It's not healthy when we have bloated balance sheets. Moving on to the next slide, will surprise nobody. Interest rates have gone up. They have started to stabilize. We'll see what happens next. Now is kind of an interesting point to be keeping an eye on this slide. As we move on to the next one, I'm going to show you a few slides. This is another one on interest rate policy and where the forecast for it is. I don't worry too much about the forecast because, you know, the market has been so wrong on this for so long. At the beginning of this year, the market would have told you that we were already going to be 2 or 3 interest rate cuts in, and that obviously hasn't happened. So, you know, this is the history. We'll see what happens. Moving on to the next slide, we're going to go through a bunch of slides about the U.S. economy. This one is actually telling a good story. The consumer in the U.S. is in relatively good shape, not overspending relative to their disposable income, relative to what they did before. This is a very positive thing structurally for the U.S., even though we're going to have recessions, that may still happen. This is quite positive. On the next slide, what you'll see, and this is going to be a series of slides that will all tell you roughly the same story. Remember earlier I talked about the U.S. leading economic index? It's in negative territory. I mean, if we look at where it is, this is recessionary territory. We have not spent time in this region in the absence of recession. Combine that with if you look at the next slide, where we see the U.S. Purchasing Manager Index, which is a survey of manufacturing companies, we're in contractionary territory. As you move on to the next slide, you see that the yield curve has been a very good predictor of U.S. recessions. That's in negative territory. You go on to the next slide, and you see that Japan machine tool orders are in negative territory. What this is if you're building a new plant somewhere in the world, odds are you're buying some of the machine tools from Japan. They're exceptional. They're so good. And it's a really good indicator of what's happening roughly in the world. So that's telling you this story. You move on to the next slide, and the China credit impulse. So China stimulates its own economy, but because it is so import driven from a productive capacity perspective and export driven from an output perspective, when the Chinese economy is stimulated substantially by the government, they buy a lot of things from local, a lot of local, 1, inputs, but 2, machines and finished products from local Asian economies, from Europe. Europe is heavily China export dependent on advanced machine tools and advanced technology and machine tools, stuff like that. This is kind of neutral. It's kind of coming out of meh territory. And I think this is the last slide. If we go on to the next one, so what those slides have told you is that we're in a place where we usually will see a recession coming. We are seeing a slowdown, a reduced increase. That's important. A reduced increase in inflation. As we move on to the next slide, we've got a picture of the U.S. gas prices. That's, again, a big contributor to inflation, political sentiment, spending. That's in better territory than it was, but it's not great territory yet. But we move on to the next slide. This is an interesting one. I won't spend too much time on it in the interest of time, but it's a picture. This isn't necessarily what I would forecast, but it's close to. But it's a good picture of what people out there think of when oil demand peaks. The light blue, I don't know if you can see my mouse on the screen here, probably not, but the light blue part of it peaks. You're in the right territory. And just we can go to the peak of that particular one. Yep, there we go. That's around late 20s, early 30s. This is what I've been saying for the past 3 years. People thought, oh, COVID, we're going down in demand for oil. No, we're not. It was an unusual time in the world where nobody was on the road and nobody was doing anything. Oil is heavily contributed by, demand is contributed from petrochemicals, from driving, from jet fuel, from diesel, a whole bunch of things. And so it's highly economically associated. We don't have the tech to move off of this yet. If you put a gun to my head and say, Ashley, you have to tell me what you think, I would tell you, I don't think we peak until we're in like the mid 2030s potentially in demand for oil. So what's happening in the world? Everyone's saying, stop drilling. Banks are being told, stop financing drilling. Investors are saying, we're not going to invest in oil and gas companies. Well, guess what? We need more oil. The other nuance here is that we have less oil each year coming out of the ground unless we put more money into it. So long and short of it is oil demand is likely to be high. That is likely to contribute to inflation. We're going to skip through here into secular tailwinds, please. I'll skip through. Actually, I'll stop on one slide on the market update, and that'll be, keep going. One more. And this is a really great slide. Rolling 10-year return. If you bought the S&P 500 10 years ago, what would your annual return have been? You're not going to be shocked to know when it's really high, trailing 10-year return, that's time to be cautious. It's such a good time to buy when it feels so horrible when the trailing 10-year return is negative. Moving on to the next slide. This is a worrisome slide. The level of concentration of the top 5 companies in the S&P 500. What percent of the S&P 500 do 5 companies represent? This is not a good thing. It is something that worries me. Moving on to the next slide, I think we're going to get into. Okay, I like this slide too much. I have to do this one. So one of my proxies for, is there something funky going on in the world? Is the Tesla valuation relative to all the other auto companies. So we see the market cap here of Tesla as of November 24th is 748 billion. The market cap of the rest of the seven biggest automakers is 616 billion. Okay, so Tesla, bigger market cap than the rest. That's interesting. But now if you look at the next slide, it tells you what the revenue is. And here you see the contrast. And what that tells you is either Tesla is going to grow incredibly strongly in the coming years, and the other companies are in a lot of trouble, or it tells you Tesla is probably a little bit overvalued. I fall in the second camp, as you might be able to assess, but they have done some amazing things. So I do continue to pay close attention to it. So moving on to the next slide, I'm going to wrap with one more after this, and that's secular tailwinds. We are cautious. We are defensively positioned. I'm concerned about the near term. You've probably figured that out if you listened to me for the past hour or 40 minutes or so. I'm so optimistic about the long term. And it's for some of these reasons are kind of the key drivers of it. We are in this amazing flywheel of innovation where innovation begets innovation, begets innovation, begets innovation. And if you think back just 30 years ago, what the world was, now think back to 40 years ago, think back to 1980. Ronald Reagan had just been elected president. The US was in a hostage crisis in Iran. We were in a recession. Interest rates had just been hitting low teens. Some of you may remember 19% mortgage rates or interest rates that you had to pay. We're so much more ahead of where we are right now, where we were then. And that's going to continue. Demographics, I think, are going to be a tailwind for some and a headwind for others. As I alluded to earlier, headwind for China, headwind for Japan, tailwind for the US, okay for Canada, tailwind for India. I'll get to that in just a second. We're seeing a re-onshoring in the US and Western countries of manufacturing jobs. That's going to be a tailwind. We're in an energy renaissance where the countries that have energy resources, I think, are going to do really well. We're in an energy transition. That is going to provide a tailwind and a lot of economic activity. It's going to likely be very positive. I'll end on India. India, I think, is going to be we're going to be talking. So in 10 years, when we look back and say, what were we talking about in the past 10 years that we weren't expecting to? I think it's going to be India. India has the best demographics in the world. The average population age is around 26 or 27. India, by the year 2047, the 100th anniversary of India's independence from the British, it will have something like 20% of the world's middle class, 26% of the 26% of the world's labor force. BCG did a study that a person born in India after the year 2000 will spend 260,000 or 240,000 in their lifetime. Multiply that by about 1.4 billion people, and you have a huge population, a huge economic environment, and they are doing this thing that has benefited everyone else in the world when they've done it. They are doing an agrarian economy to an industrial economy transition. And if you think about just one person who moves from a farm where they can only produce what the strength of their arms and their back produce, you take that person and move them to a city and you pair them with machines and you multiply what they can produce. There's a huge productivity tailwind you get, and India is in the early days of that. So I think it's going to be a huge tailwind structurally for the world for a long time to come. I will wrap it up there. Thanks so much for your time. If there are questions, now is a great time to jump in. I know I ran a little long. Unfortunately, I tend to do that. Hopefully it was interesting.
Ashley, thank you so much. That was always insightful as always. And you know what? Forget about the time. You're always passionate. And I know that you talk from the heart. And that's what we see as the results of the mandates you manage here at Empire. So thanks for carving out a bit of your time this afternoon to join us here and our fine valued advisors at IDC. Thank you.
My pleasure. Thank you for having me.
I don't see any Q&A, but what I'll do is I'll just finish off the presentation. I will defer to, I'll defer back to Graeme in just a minute, but I do want to let everyone on the line know just some of the things that we're actually looking at and what we're working on. What are we cooking in the kitchen for 2024? You should walk away and look at your books of business with these thoughts in mind. We will be looking at an RDSP launch in Q3, Q4 of 2024. This will be terrific. SEG funds in the RDSP world, I think is a fantastic, or rather the disability world, I think is a fantastic addition to what we can offer our clients. We are looking at the new home buyer savings plan. We should be launching that. Look for that somewhere around the middle to the end of January of 2024. So we can get some of your clients, younger kids, saving well for their homes going forward. And something that is very exciting for those of you that are on the line this afternoon who are aware of our eVision illustration software on the life insurance side, very, very excited to say that we will be shortly coming out with an eVision version for our investment side very, very shortly. So there's a lot of wonderful things that are being cooked in the kitchen right now at Empire, and we look forward to serving them up to you as advisors in the field come 2024. At this time, though, I would like to defer back to Graeme Allan for any closing comments. Graeme?
Ian, thanks very much. Ashley, thank you. I'm so glad Paul didn't show up today, because that means we've got to listen to you for a much longer time. And quite frankly, I think another hour would have just flown by as well if we'd given the opportunity if we had that time. So lots of amazing information, lots of stuff that I know that people will absorb, they'll think about, they'll forget. But that's why Ian, myself, and Alex are here to help kind of take that information and get the right stuff by, so that you can spend your time doing what is the best thing, and that's managing money, and probably your first love. So thanks again, Ian. The RDSP story, I love it. I think that's just, there's not a week goes by that Alex or myself doesn't get asked the question about where can we buy an RDSP. It's a product that means so much for a part of the population that can really use that product to benefit their lives. And quite frankly, I commend Empire for doing that. That means a lot. And something that people can have in their toolkit, and it's another thing that when they're out seeing clients that can bring out to find a solution. So that's me. Thank you very much to the whole team. Alex, if maybe you want to add a couple of words yourself.
No, I just wanted to say thanks again to Ian. Man, I tell you, one day when I grow up, I want to have Ian's enthusiasm. But thank you, Ian. And Ashley, it's learn something new every time I listen to you talk about the markets and investing. So thanks again. And yeah, as Graeme was saying, please reach out to any of us. And we've got a great partnership and relationship with Empire Life going on, many decades. So again, please reach out. And once again, thanks, Graeme, for hosting. Thanks, Ashley, for your great presentation. And Ian, thank you again so much, and wish everyone a great afternoon.
Thank you. Thank you, Alex.
Bye, everybody.
Bye-bye now. Good afternoon.